Hi, this is Lynn Sautter Beal of Upstart, and welcome to Leaders in Lending. I'll be joined today by Penny Lee, who is the president and CEO of the Financial Technology Association, a Washington, D.C. based trade association representing fintech industry leaders. The FTA educates, informs, and engages with Washington, advocating for modernized policies and regulations that spur innovation and drive inclusion. Let's get started. Hi, Penny. Thanks for joining me today on Leaders in Lending.
Thanks for having me, Lynn. It's a great honor and pleasure to be here.
Great. Well, your website says that the FTA educates, informs, and engages with Washington, and you're advocating for modernized policies, regulations that spur innovation, drive inclusion. Can you expand on that and kind of, in your words, describe the mission of the organization?
Sure. Yeah, it's a little bit taking out the word salad, as they would say. And so, what we do is we represent fintech, the fintech industry, in kind of a wide aperture of how we define it, primarily as digitally native financial services companies. And so, those are things that people use on an everyday basis, whether or not to have their DoorDash delivered and paid for, but a buy now, pay later product, a P2P, Venmo, a Cash App, all those kind of varieties. And what we do is we sit in the nexus of Washington and try to translate business to Washington and Washington to business, and try to and work with the regulators, legislators, and others to craft and think through how to put the U.S. kind of in the forward looking phase of what is the future of finance, meaning what are the regulations that we need to put in place that modernize to fit the products and services that are now in the marketplace? What is the type of legislation we need to look at, or what are the types of things we need to adopt, again, to make sure that the U.S. remains competitive, not only in the products and services that they offer consumers and small businesses, but also in a global sense. We're now in a global world economy and in a global competitive landscape. So we want to make sure that our consumers, when they're traveling overseas, has access, that our rules and regulations allow for this free flow of money, but also to use the ingenuity that is occurring kind of on a global scale to be able to have that adopted here in the United States.
Yeah, that's interesting. So what do you, I know there's a few different kind of fintech or financial industry associations growing up, and I do think they really kind of focus on different areas. And what in your mind really differentiates then the FTA from some of the other organizations?
I would say, it was started kind of to try to address kind of the larger fintech industry. And so we made, as I said, we made the definition of it broad, but yet narrow, in the sense of trying to capture all that is encompassing of, financial technology or those products and services that are in that space. And so we don't focus on where some might have a more niche where they're representing just those that are in the lending space, or just those that are in the data aggregation space, or just those that are in just a little bit more of a niche area. So we try to represent those that are in lending, those that are in payments, those that are in the capital market space, those that are in buy now, pay later, or earned wage access, or other, kind of what makes this ecosystem of fintech. So trying to represent the broader industry.
Okay. Okay. No, that was certainly helpful. So, and I think you personally have a really interesting career background, kind of a combination of politics, policy, angel investing, and tell us about that. What your career path looked like, what different areas have you worked in, and kind of how you ended up rather, leading the FTA.
So it started, first love was in campaigns. I volunteered for my first campaign when I was 14 years old, and that was the path I was going to go. Studied political science and journalism in college, and then immediately after college, got hooked, got connected with the campaign in Texas, and then just that spurred kind of that work that I did there for many years. Was with the Democratic Party and worked on had the privilege of working on a couple of presidentials, and then was with a governor in Pennsylvania, Governor Rendell, and then from there was recruited out to run the Democratic Governors Association, and then that led me into working with then Majority Leader in the Senate, Harry Reid. And it was during that time, we was hired in '07, and during that time, we obviously faced a financial crisis in '08. And it was an incredible moment in time to be part of that conversation, but also a very heady days, very scary days, very defining moments that we had it periodically throughout that. But what we did see was it was a time where, there was always this kind of disdain to have to engage in Washington, and kind of a, well, they don't really understand what we're doing anyway. So a kind of an avoidance of Washington.
Mm-hmm.
And what '08 really proved across all different sectors was you need to spend time in Washington, because there might be a time when, one, they need to bail you out, or two, that you have to make sure that they understand what your products do and don't do. And so when I left the Hill, that was something that I carried out with me, was again trying to not be scared of Washington, but also to the lessons that you learn in those companies that had taken the time to educate along the way, that it wasn't only in a crisis that they were coming to Washington, that it wasn't only in a negative light, but had systematically and periodically showed up time and time again. So we had a good understanding. And, that really illustrated one night, early in the days of the financial crisis. I never forget the first time we really had Secretary Paulson and Chairman Bernanke come to the Hill, and to present kind of what was happening, because all of a sudden, incredible amounts of activities. Bear Stearns was in trouble, AIG was in trouble, like all of this activity was going on. And it was the first meeting in which we expanded it to more than just leadership staff, and now it was the banking staffs and financial services and all the different staff in a room. So it was probably about 50 people with principals and staff. And I'll never forget Secretary Paulson asking, okay, just want to understand the room. Who has ever traded a derivative? No hand goes up. And
Sure.
he was like, okay, who's ever worked on Wall Street? Not a hand goes up. And he's like, okay, so this is going to be a theoretical exercise. And, he, slowly educated us all on kind of some of the nuances, but it was his own personal relationship that he had with the Wall Street community and others that kind of helped us lead us to a place where we ended up getting to with the TARP and other aspects. But that kind of illustrated how important it is to, again, maintain that conversation, develop those relationships. So when there is a time of crisis or need, or trying to think forward, how do we reshape the United States, right now, on kind of what this future of finance looks like? That process is there. And so that's kind of translated to where I am now. I came into this role working at a firm called Invariant, a lobbying and public affairs firm. And we had several fintech clients, and it was them that recruited me to ask if I'd be interested in building out this new trade association that represented the larger industry.
Okay, great. Now, I love that anecdote about Secretary Paulson during the great financial crisis. And I think I also did a lot of campaign work, although I didn't translate it then into later careers after college. I went directly into financial services. And I always tell people that campaign politics is in many ways kind of a hand-to-hand combat, and it really prepares you for a lot of difficult situations over the course of your career. And I think people who have that experience tend to kind of roll with it when challenging things happen, because you started out early with difficult bosses and a variety of experiences. So in '08, I was actually working at Smith Barney at the time, which does not exist as a company anymore. So, I was working for an institutional consulting team. Certainly kind of felt and saw the industry disruption firsthand, although not in New York or DC. Were there times during those years where you felt like, we don't know where this is going to end, and we think the landing could be very, very hard, and just the unknowns? Like, what was that like from I think emotion standpoint of really being in the room where a lot of really important things happened?
It was, you didn't know how big the contagion was. You didn't necessarily know, other than the banking community, also what was being affected. And then you had the global component on it. And so it was every hour, every day, realizing this, while it might have just seeseemed isolated initially to a housing and to Wall Street and to, some niche products that were, over securitized or over exercised, it then every day became bigger and larger. And then you had multinational companies saying, I can't make payroll. The banks have called the paper. We leverage on a daily basis just to meet payroll. We're going to go under. And these are major multinational non-bank companies that were starting to feel these overall effect, let alone the hundreds of thousands of people that lost their homes and trying to find, a new way, or how they were going to live as well. So it was just this complete uncertainty, and, wanting to, not knowing, especially initially, where to put the finger in the dike. It
Mhm.
wasn't which problem to solve. It wasn't just one, sector that we could solve for. It was multi. And so, I credit the leadership of Secretary Paulson and Chairman Bernanke and the Fed governors that were involved, and the leadership in the House and the Senate, to be able to look at the landscape, put politics aside. And there was, obviously some very partisan, um, features to have to work through, but, to go to the White House and have Speaker Pelosi, to have Leader Reid, to have McConnell, and to have others there putting aside and saying, what do we need to fix this so it's not an overall collapse? And so that was what you just didn't know. You didn't know where the floor was and which finger to put in which dike, at that point.
Sure, sure. Yeah, there's a great quote that I heard the other day, and I can't recall offhand where I heard it, but I've repeated it, and it's been repeated by a couple of my colleagues here at Upstart, that you have to be willing to sprint when the distance is unknown.
Yes, exactly.
Yeah, and that's I think very much true when growing either a startup or a company through kind of rapid growth phases. And after Smith Barney became no more, I did have the opportunity later on to work at J.P. Morgan, and the Federal Reserve kind of reform around tri-party repo and white paper was something that I helped implement at the bank, I managed one of the teams that worked on the global liquidity trading there. And so that was certainly interesting to then see some of the cleanup. What are some of the other kind of industry changes you saw coming out of that? Like some of the positive things that you feel like were really done well, in addition to the kind of bipartisan work to clean up a big problem, but maybe like new regulation or new oversight that came out of that.
Yeah, well, I think, plus or minus, however, whatever your opinion is on the Consumer Financial Protection Bureau, the creation of that bureau has a positive effect. It now has, again, depending on the directorship or depending on where your perception would be, but just having the notion that there is a regulatory body having a perspective of what is best for the consumer. How that's interpreted is, I'll leave that to others, but that was something I think that has been overall positive, to have that notion and to have a place where consumers can go, consumers can have a voice, and at the same time thinking through the products and services that are in the marketplace to ensure that there is consumer protection components to it that might not have been there prior. Because you want to make sure that every product coming into the marketplace, especially that with money, that touching consumers and small business, has the full safety and soundness, that there is, a fairness element to it as well, but can instill the trust of the users for it. So I think that was, something that was good. Obviously, some of the aspects in the mortgage industry, some other reforms that have taken place in that respect have been good. Some of the other, consumer protection aspects of some of the financial sectors. I'll let others debate currently on Basel III Endgame, but there was obviously higher capital requirements. Some of the work done on the testing of the banks and the stress testing, and just ensuring that there was a greater dialogue occurring between Washington and what was happening on Wall Street, I think has been overall a positive effect.
Sure, sure. And I know, here at Upstart, we, there's kind of a funny story about some of our founders and early employees kind of walking into the OCC office in San Francisco and just saying, "Hey, we're going to do this thing. Do you want to talk to us?" And that isn't a very common practice. I'm sure the regulator didn't really know what to make of them at the time either. But we've got a long-standing history, through our work in our government affairs team and engagement of our risk and compliance teams of working with the various regulatory agencies, kind of opening up the company as much as possible. And then obviously where we have, we do have state exams as a lender or as a broker, and kind of indirectly through many of our bank partners and credit unions that we work with. So, we spend a lot of time, I think, engaging with the regulators. And I definitely think that your experience, having kind of seen the worst of what can go wrong, and where things can spiral pretty quickly, is really helpful. And there are certainly areas in the fintech industry where people may not have that kind of global banking perspective and have not seen things go wrong. They've only seen it go up. And I think last year opened some people's eyes with the bank failures and the kind of after effects of stimulus wearing off. So I know you've said before that the FTA is really working to use innovation to better those consumer and small business outcomes. What are some of the products and services being developed or kind of in the market as you see most innovative or that you're really excited about right now?
Yeah, I would say that, and again, going back to what you asked about coming out of '08, I would say separately from the innovation space or separate from the regulation space is the innovation, what has occurred. And you see a lot of products that came out in response, similar to Upstart and others that were filling a marketplace gap, because what you did see was still the need for access to credit, access to affordable credit, and in a way that could, reach those that might be credit thin, not have a credit report, underbanked, underserved, but do it in a way that's not predatory, that does it in a way that allows them to be able to, buy a home, finance a car, other means, but not in a way that puts them in incredible revolving debt or in compounding interest, vehicles on that respect. So I think there's been a lot of incredible innovation. And as we've gone, and you saw another uptick, especially on adoption during the pandemic, when people are at home, not going to a bank, and having to relive their financial lives in one that is much more digital. And so a lot of the innovation in this space has been, from changing the way in which we interact with financial services, how we get the delivery of money, how we're able to just kind of work on that aspect. But it's also just, some foundational, just for the ability for you to accept a credit card online, the ability for a small business to be able to have one place where they can do their bill pay, manage their treasury, all of that aspect of their whole, get access to credit, is now something that is an everyday occurrence. So, some of the products that are in space or in the space that I think that are really exciting, again, building on what some of the foundational things was. I think now it's just taken for granted that, oh yeah, I can get my DoorDash delivered and,
Sure.
with a debit or credit card, and it's seamless, and not realizing it probably goes over 4 or 5 of our fintech rails to make that happen. It just seems ubiquitous and seamless. But what you are starting just the availability, again, from a small business and consumer, that access to credit and access to more affordable credit. Acting comptroller Sue likes to say being poor is expensive, because it requires you, oftentimes to get they require a higher interest loan, or they require, having more liquidity or denial of certain aspects. So, what we did see during the pandemic, especially, was trying during the first phase of the PPP was trying to get money out the door if they could, people without bank accounts or without relationships with their bank, they weren't able to access, this incredible program. And so just that kind of overall need to be able to meet consumers and small businesses where they're at, using digital tools that they want, to be able to, and provide consumers with just more choice in the marketplace.
Sure, sure. And I do think that that is always a good quote, that being poor is expensive. And I think we all know the stats around what a simple emergency like a car
Yep.
breaking down, a medical bill, unexpected sickness where you're out from work, and how impactful that can be on a pretty large set of population of Americans. I think one of the new products that I know all of our
Mhm.
listeners are familiar with, or newer products, not new anymore, is
Mhm.
buy now, pay later, or BNPL, kind of the point of sale financing, whether
Mhm.
online or in store. I do think the reputation sometimes can be a bit mixed. People think it's a lot of things, and
Mhm.
aren't exactly sure what it is, especially if they don't work directly in the fintech industry. Can you share your thoughts, though, on what you see as some of the benefits of those products, particularly for those consumers?
Yeah, buy now, pay later is kind of almost turned into a marketing theme, a marketing tool versus what it
Mhm.
actually is. And it started, it started originally in Australia and in Europe, and again to that point of sale financing. And for the traditional BNPL, I would say it's still so new. It's a zero to low interest product in which you're able to make 4 payments over the course of 6 weeks to pay for a product. So it's a great tool. Again, bringing competition into the marketplace. It allows people, if just an alternative payment, if
Mhm.
they need to spread their payments again to meet their paychecks, or whatever the case might be, or to address an emergency immediately, they can do it in a way again that has the zero interest. Do it in a way that when they pay it off in four weeks, they don't incur any other fees attached to it. So it's a lower cost option, that allows you to spread your payments over four. So, yesterday the New York Post, or the New York Fed, put out a blog on their recent research, and you are starting to see, a lot of folks having, and we saw it during the holidays, an uptick in kind of uh, the use of buy now, pay later, as we would define it, the pay in four, zero to no interest
Sure.
products. And that's because, just again, people want alternatives in the marketplace to be able to use a payment product that fits their need. Back in the day, I remember when credit cards started to get more adopted. And the first time I used it in a grocery store, my dad was appalled. He's just like,
Mhm.
"How come you're using a credit card?" And I was like, "Well, one, it's convenient. Two, I'm not incurring interest because I was only, paying what I could afford at the time." And so I said, for me, it's just convenience, and I'm not incurring any other fees that I wouldn't any otherwise. And so, now it's just ubiquitous, and everybody's now, tap to pays, with credit
Sure.
card or others. So, that adoption we're starting to see, similar to buy now, pay later, as an alternative payment that helps people budget and finance their needs.
Sure. And I think uh, I'm not sure. I think my parents do primarily use cards now, but they've been slow adopters in that
Yeah.
way too, where it was always a sense of, why would you use a credit card if you have the money?
Yeah.
And there's a lot of reasons, and I do see a lot of the credit card companies now offering the pay over time feature, which is kind of an embedded short term
Yeah.
installment. Pay over 4 months instead of having that accrue interest and hit your balance, and have more of a variable monthly payment. But of course, then you have to qualify for that credit card the first time, which I think a lot of there's probably a good chunk of buy now, pay later frequent users who don't who may not have qualified for that yet. And
Yeah, and a lot of buy now, pay later, 85% use a debit card. So they do. There's an or an allergy, I guess, to
Mhm.
credit in that sense. You saw that shift after '08, where either they saw what their parents had gone through or others around them. And so there is that more default to into a debit account versus a credit card, use of credit cards. So that's a shift in consumer behavior as well.
Interesting. Yeah, I could definitely see that. And I think I know you and I talked before about kind of BNPL and credit reporting. And we've certainly talked about that at Upstart as we use a lot of consumer credit data as inputs to our underwriting model. I know some of the different companies have taken different tacks with, do they report the first line? Do they only report if it's negative? Does it have to be over a certain amount of time?
Mhm.
It doesn't seem like there's a lot of kind of standardization yet. And I think you could certainly argue that it may, kind of hide the risk or obscure
Mhm.
somebody's real DTI. Do you think that's valid, or do you think that's more of a kind of theoretical fear of new products that people may not fully understand?
What's unfortunate right now is again is the credit. It's hard for credit bureaus to capture the positive aspect of somebody that uses buy now pay later in a responsible manner, in a way in which they're paying it off each cycle, or each 4 week period, and doing it repeatedly and not being able to build positive credit. Because right now what happens if you take out one, two, or three different BNPL loans or use BNPL products, you're maxing out your amount of available credit, which could seem as a negative. And so that, until we solve some of those issues within just the credit bureaus weren't built to capture daily, transactional information, 2 week transactional information. They were more capturing, or still try to capture, those larger payments, monthly payments that you do for home and um, utility, car, and other aspects of it. So that ability, I think there's a hesitancy until you can fix that issue, and for them to be able to really understand the frequency, the amount, the regular cadence, that it's not maxing out a credit in a negative way, but yet in 4 weeks you can show somebody with a responsible repayment, and that should be seen as a good credit indicator. Those are some of the hesitancy that you have in the marketplace. And then with only three bureaus, there is not harmonization across
Mhm.
each. And so viewing each of this data in a very different way is something that is just too cumbersome for the companies to report into, because it will be translated differently depending on the company in which they're engaged with. So just a little bit of I think the buy now pay later industry is ahead of the market as far as on the credit reporting side, but it's something that our own companies work with, very buy now pay later, work with the consumers, and there's protections built into them. You pause. If someone is late on a payment, they are paused from using that product again until that is satisfied. So they are, they're in their own underwriting, they're trying to mitigate that risk as well and not put somebody in overextension. And these are often, I think the average right now use of a BNPL product is like $147. So it's a very low, it's a much
Mhm.
different product than, like I say, a mortgage or a car or a purchase, a large
Sure.
purchase. These are very, very small, oftentimes are very small purchases that are used on a frequent basis.
Sure. And I do think a little bit of the just novelness of them
Mm.
is, and the unknown
Yeah.
around that, because people can certainly get themselves into a significant amount of trouble quickly with credit cards,
Yeah.
and the fees and the interest can build up to a place where they can't support those payments. I do think I know all of the credit bureaus have built various kind of features and products to think about kind of those off trade line. Uh, Payments like utilities and cell
Yeah.
phone bills and rent, and how do you give people kind of credit for those sorts of activities, to help kind of build their credit profile and have a more visible risk footprint.
Yeah.
I think one of the other newer products that's getting a lot of attention, and all of our listeners may not be as familiar with it, is earned wage access, which you had mentioned earlier. Can you talk a little bit about just what that is, what that
Yeah.
means, and what are some of the solutions you're seeing out there?
Yeah. And I would say it's kind of broken down to what you defined it as in the sense of it's earned wage access. And so it's access to your already earned wage. As we know, oftentimes here in the United States, we are paid either every 2 weeks or once a month. And to our earlier point in the conversation about there are times when people need liquidity, they need access to funds prior to a 2 week pay period for a variety of reasons, or they would just like, we do have a lot of folks that use earned wage access as a budgeting tool. They know, if they get it funds on a more steady basis, they know exactly what they have to spend. So there's a variety of reasons, but essentially it's to help tide over in between work periods. It's accrued, it's based on what you've already earned. So when you go to work on a daily basis, back in the day, it would be like, can I get maybe a cash advance? And it was, money taken out of the till at the end of the night and,
Sure.
given to you, and with the promise of being paid back. It's kind of in that same vein now, obviously in a digital manner. And so it's allowing people to have access to the wages on a daily basis or on depending on their frequency, on a regular basis, based off of kind of what you've already earned. So that's the innovation that is happening. There's two different, I would say, ways in which it flows. One is employer based. So many companies are working directly with an employer, and it's an added benefit that they provide to employees. And then the other is direct to consumer, where you have companies in this space those that don't have employers, such as, the United States House of Representative only pays once a month.
Mhm.
And so we have a couple hundred, House members or House staffers that use the product, that obviously the employer does not pay. So you have, employers or employees that perhaps are gig workers, 1099, or their employer is not engaged in an earned wage program that allows them, again, to be able to have access to their wages sooner than their pay period.
Sure, sure. Yeah, and I think that can be certainly meaningful. Do you, from the products that you're seeing out there, are you seeing where people are kind of generally using those on a regular basis? Is it they like to have the kind of safety and security of getting advanced access if needed, or is it kind of a mix of behaviors as those are getting more popular?
Yeah, it's really a mix of behavior. It depends on kind of what the needs of the person is. Some that, like I said, want to use it as a budgeting tool so they know, exactly how much they have to spend either on a daily basis or on a more frequent basis. Some that, need a car to work, car breaks down, they need access to a low cost, low fee, no fee product. Because right now, alternatives in the marketplace are ones that do have high interest based on trying to trap you into, they make money when your behavior, when you aren't able to make a payment, when you aren't
Sure.
able to satisfy an obligation. That's how they make money. So they want to, push you into a risky behavior, which, to help them. Whereas these products are, there's no recourse, there's no interest, there's no fees attached. There is a aspect of them that, allows you to have access to your earned wage on a more frequent basis. So mixed use, on kind of why and how people use it.
Great, great. Well, I think kind of one really last question that I think I'd like to get your thoughts on. We've talked certainly about some of the new products and some of the risks out there, but really, like, how do you think about these either novel or emerging financial products? Like, in what ways can they be a positive impact to consumer credit reports, and not just their credit report, but really just their overall financial health and wellness?
Yeah, I mean, eventually you would want to be able to have this data available, the frequency of use, how, those that are repaying their obligations on a steady and regular basis, just that they're showing and demonstrating responsible behavior. And that should be rewarded either on a higher credit score or allow them to have, to your point, to have them to have access to more capital, to, if they want to start a small business, if they want to, use it for a variety of different matters and means. So I think the positive aspect is that there are low fee, low cost, affordable products that are now coming into the marketplace that allow consumers and small businesses to have access to this affordable capital to be able to, one, live a healthier life, two, meet the needs of their friend, of themselves and their family, three, be able to start incredible businesses without having to go into so much debt, but to be able to really thrive in this economy.
Sure. And I'm excited to see over the next kind of 5 to 10 years where things head. I think, we're certainly seeing that the states aren't quite sure where they should regulate, where the
Yeah.
federal legislation, which agencies are in charge of what. And I think it'll be it's great to have organizations like the FTA out there kind of leading the charge and working through these issues. But thank you very much. Appreciate the conversation. Glad to have you on the podcast, and just thanks for your time today.
Thanks, Lynn, so much for having me.